Well, there's been plenty of news for markets, both positive and negative, and markets continue to grind higher. So hi there everyone, welcome to the Traders Circle Weekly Market Update. Today is Tuesday, the 20th of May, 2025, and before I start, you do need to be aware that whatever I say is general advice only. So today was RBA Day. It used to happen on the first Tuesday of every month, and now it happens every 6 weeks. You'd think that with the decreased frequency, we'd see a bit more color, a bit more commentary, and a bit more, more updates in their accompanying statements. But that simply hasn't been the case, and that is despite a rate cut today. So we did see the RBA lower the Australian cash rate by 0.25%, 25 basis points, which was pretty much expected by the market. If you've been watching my videos, you would have probably recalled me saying that the market has been pricing in up to 4 additional rate cuts this year. That's been cut down to about 2 additional rate cuts this year, and that's simply because the Australian economic data continues to come in strong and inflation isn't moderating perhaps as quickly as initially suspected. So overall, the Australian economy looks to be going fairly well. It's not slowing perhaps as much as expected. Demand remains strong, spending remains strong, and most recently we had a pretty strong unemployment report. So the RBA cut, but they cut more because they could cut rather than to stimulate the economy, because as I mentioned, that is going pretty well. Now, the accompanying statement was perhaps a little bit more dovish than expected. The RBA basically said at the end of their statement that they stood ready to essentially cut interest rates if the economy weakens. And that's basically a bit more of a dovish position. I think some in the market, and perhaps myself included, were expecting them to come out and say that, unemployment's been strong, there's risks to price from a whole bunch of different factors going on, and they did point to, strong wages as well in their statement. And they didn't do that. They basically said there's a risk of a global economic downturn that could affect Australia, and that they have room to cut rates if necessary. So that statement, being a bit more dovish than expected, actually led to Australian government bond yields coming off, and that's basically what we see in this chart here. Right around 2:30 was when the statement came out, and we can see that the yields trailed off for about the next half hour. We also saw the stock market push up a little bit, although really not an awful lot. I think it was up about 10, maybe 15 points after the statement was announced, just coming off the lows of the session from before the statement. So the RBA was a bit more dovish. That was a little bit of a positive for the market today, but probably not enough to keep markets in a more positive frame of mind moving forwards. I suspect whether or not our market is more positive moving forwards is going to continue to come down to the US market. And just on the US market, they did see a ratings downgrade late on Friday after US markets closed from the ratings agency Moodys. So Moodys lowered the rating on US government debt from AAA to AA1. I think it's the equivalent to AA plus at S&P ratings, and it basically brings Moody's ratings in line with the other major ratings houses who've all lowered US government debt rating from the maximum to the second maximum. Now, in the short term, this probably doesn't mean an awful lot, and like I mentioned, the other ratings agencies in the past have already lowered US government debt. So it probably doesn't mean an awful lot for anything. We did see US government bond yields tick up slightly after that, and I think that's just as much a factor of why the ratings was lowered rather than the ratings themselves being lowered. The reality is that the US government is printing money at a rate of knots, pretty much the fastest rate ever. US government debt is 7% of US GDP. What that means is, US government deficit is 7% of US GDP. What that means is that if the US government was to run a neutral budget, we would be in a pretty severe global recession. If they were to have a budget surplus, most likely that would mean a huge economic downturn. Essentially, the US economy is being propped up by continued and growing money printing. That basically calls into question whether it can be sustained, and hence the ratings downgrade. Now, one of the positives, at least in the short term, for the extreme amounts of US government money printing is all that money has to flow somewhere. And that's what we're seeing in global asset markets. We're seeing it in the share prices that we're currently seeing. We're seeing it in Bitcoin. We're seeing it in gold. Essentially, they're creating huge amounts of money each year, huge new amounts of money, and that's flowing into asset prices. Now, I've heard it said before, and I'll reiterate it here. It doesn't necessarily mean that shares are becoming more valuable, rather that US dollars are becoming less valuable. And that's simply because, they're printing huge amounts of new dollars each year, mostly due to, or in large part due to, US government money printing. Will it all end in tears? I'm firmly in the camp that it will. I think we will see a fiat currency crisis at some point in our lifetimes. Doesn't mean it's going to be soon. But it will become an increasingly big issue. We will see increasing volatility due to that fact in the next decade, and it's all going to come down to how they address it, how the US government addresses it. It's not going to be Doge. I don't think it's going to be through spending cuts. The only way to address it will be through taxation, in my opinion, and yeah, I'm not sure how they'll be able to go about it, but definitely going to be something to watch, because it will lead to higher bond yields, it will lead to bigger issues, and I think it will start spiraling into an uncontrollable phase if not addressed soon. Finally, just wanted to touch on the trade war as well. There's obviously been a trade ceasefire between the US and China, the 90-day lower tariff rate pause. So the US tariffing China's imports, or imports from China, at 30%, and the China tariffing imports from the US at 10%. The market applauded that fact. They've been up a little bit since then, but the reality is that 30% is still very high. I've heard some estimates that more than half of Chinese imports to the US are not going to be economically viable at 30% tariff rates. And really, we've only just started to see the effects of these tariffs now. I think I mentioned last week that only over that weekend that the first lot of new tariffed cargo was coming into the US. This is going to start showing up on economic data points in the next couple of weeks, and I suspect that the market has really underestimated the impact from it. And when I say the market's underestimated the impact, I don't necessarily think the market has underestimated the impact. I think more so that buying has beget buying, and that people are believing they can get in and out quickly. They can get out before the worst of the situation hits, before things start turning really sour, and that might prove to be the case. But it also means that if there is a bit of an economic downturn from the tariffs, that there probably will be some pretty quick, sharp selling. Like I said, potentially people thinking they can get in and out pretty quickly, and that means that they'll be getting out quickly as well if things do start to turn around. So if we do see another dip, it could be quick, it could be violent, and yeah, I would suspect that it could be pretty large. Obviously, it's not going to happen overnight, but something to watch for probably in the next fortnight or so. So let's have a quick look at the charts for this week, guys. This is the US S&P 500. They jumped higher after the tariff ceasefire was announced last week. That was this day here, and they've ground a little bit higher since. Not a huge convincing move, but really sort of a series of smaller moves. Indeed, overnight they opened strongly lower with the ratings downgrade, but they managed to close higher for the 6th straight session. To the upside, the likely target is 6,000. That was a historic level, and it was maybe also support late last year. If they can break through the 6,000 level, they will be looking at the all-time high level, probably around 6,150. If we do see some selling from here, the first downside target is likely 5,800. That was previously a peak back in late March, and it was also the level they gapped through after the tariff ceasefire. So like I said, to the downside, 5,800 target in the short term. To the upside, 6,000 point target in the short term. If we have a quick look at the Australian market for this week, we can see that we had a pretty strong session during today's session, and that was pushing us back to the 83.50 resistance level. Now, we reached that level on Friday. We tried to break through it, but we fell from that level in yesterday's session, in Monday's session, and that was because of the US ratings downgrade. US futures moved strongly lower. It looked like the US was going to have a pretty negative session, and then they actually ended up finishing slightly in the green. So with their reversal overnight and with our RBA rate cut today, we reversed Monday's losses. That still leaves us just below the 83.50 resistance level though. If we can break that level, we're starting to look around 8,500, maybe up to 8,600, our own all-time highs. But if we hold this level and see some selling, I suspect our downside target is likely to be 8,150. That was a pretty key level historically. It was a key level at the start of the month. That's also where our 200 and 100-day moving averages sit. So I will wrap it up there for this week, guys. I think the markets are at a bit of an inflection point after a pretty strong rally over the past sort of couple of months, rebounding off their lows. They've been spurred higher by some positive news, but it could be a bit of a case of buy the rumor, sell the fact, because like I said, we're about to start seeing the effects of some of these tariffs, and it's not like prices are at their lows. They've actually recovered quite strongly. So there is room to the downside. There might be a little bit more room to the upside, and the momentum is certainly to the upside at the moment as well. So hopefully you guys enjoyed the video. If you did, click like, click subscribe, and we'll see you guys next time.